If you're a first-time home buyer, the mortgage process can seem overwhelming, especially with all the industry jargon. We talk in acronyms all the time, and it can be very confusing. So today I'm going to explain some of the frequently used mortgage terms just to help you understand the process a little bit better. So let's get started. Amortization. This refers to the process of gradually paying off your loan through regular payments. Each payment reduces both the principal and the interest, with the proportions changing over time. An amortization schedule shows how much of each payment goes towards principal and interest. An adjustable rate mortgage has an interest rate that can change periodically based on the market conditions. ARMs typically start with a lower fixed rate for a set period, after which the rate adjusts. They can be a good option if you plan to move or refinance before the rate adjusts. An APR, or an annual percentage rate, includes the interest rate plus other loan fees, giving you a more comprehensive view of the loan's total cost. It's a useful figure when comparing different loan offers. Closing costs. We all love closing costs. These are fees and expenses you pay when you close on your home. These can include loan origination fees, appraisal fees, title insurance, and more. And the setup of your escrow account, which includes your taxes and insurance. They typically range from 2 to 5 cents of the loan amount, depending on the loan size. DTI, or debt to income ratio. This measures your monthly debt payments against your monthly gross income. Lenders use this ratio to assess your ability to manage monthly payments and to repay debts. A lower DTI ratio can improve your chances of getting approved for a mortgage. The down payment is the amount of money you pay up front when buying a home. It's usually a percentage of the home's sales price. A larger down payment can reduce your monthly mortgage payments and may even get you a better interest rate. Equity. Equity is the difference between the market value of your home and the amount you owe on your mortgage. Building equity can increase your financial stability and provide options for future borrowing, such as a home equity loan or a line of credit, also known as a HELOC. An escrow account is set up by your lender to pay property taxes and homeowners insurance on your behalf. Part of your monthly mortgage payment goes into an account to ensure that these expenses are covered. A fixed rate mortgage. A fixed rate mortgage has an interest rate that remains the same for the entire term of the loan, providing predictable monthly payments. It's a popular choice for those who can pay or plan to stay in their home for a long term. Gross income. Gross income is your total income before taxes and other deductions. Lenders use your gross income to determine your borrowing capabilities and to calculate your DTI ratio. The interest rate. We hear a lot about interest rates these days. This is the cost of borrowing money expressed as a percentage. It can be fixed, meaning it stays the same throughout the loan term, or adjustable, meaning that it can change periodically through the course of the loan, depending on market conditions. Loan term. The loan term is a length of time you have to repay the mortgage. Common loan terms are 15, 20, or 30 years. Shorter loan terms generally have higher monthly payments but lower total interest costs over the life of the loan, while longer loan terms have lower monthly payments but higher total interest costs. So the lower the rate, the lower the cost. The longer the term, the higher the cost. LTV, or loan to value, compares the amount of your loan to the appraised value of the property. For example, if you're buying a home for $100,000 with an $80,000 loan, then your loan to value, or LTV, is 80%. A lower LTV can qualify you for better loan terms. PMI, or private mortgage insurance, is required if your down payment is less than 20% of the home's purchase price. PMI protects the lender in case you default on the loan. PMI can be removed once you've built enough equity in your home. PMI is only removed on conventional loans or FHA loans with 5% or more down. Your originator should be able to tell you the differences. Points. Points are upfront fees paid to the lender at closing in exchange for a lower interest rate. You're basically paying interest up front so that you don't pay it over time. Each point costs 1% of the loan amount. Buying points can save you money over the life of the loan if you plan to stay in your home for a long period of time. Pre-approval. This is the preliminary evaluation by a lender to determine how much you can borrow. It involves reviewing your credit score, income, and other financial information. A pre-approval letter shows the seller that you are a serious buyer. The principal. Principal is the amount of money you borrow to buy your home. Your monthly mortgage payments can gradually reduce the principal over the life of the loan. Understanding these mortgage terms can help you navigate the home buying process with confidence. If you have any questions or need personalized assistance, feel free to reach out. Thanks for watching and best of luck in your home buying journey.